at the end of this year, I don't see how inflation on a year-over-year basis can be less than 7%. And at the end of 2023, the same exercise is probably going to have you around 6%.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Inflation remains at a 41-year high and continues to severely pinch households when paying for food, gas, and nearly everything else. How much longer will it plague us, and might it get even worse from here? To find out, we welcome Steve Hanke back to the program. Steve's professor of applied economics at the Johns Hopkins University in Baltimore, Maryland, and the last time he appeared on this program, he correctly predicted that America's Consumer Price Index, or CPI, would hit 9%, which it just did last month. Steve, thanks so much for joining us again today.
Good to be with you, Adam.
All right, Steve. Well, look, inflation is still front and center. I just gave you props there for your very prescient call that you made when you were on the program last. I want to dig into that pretty deeply with you in this conversation. Real quickly, though, I'd like just to start up at the very top of things, if you don't mind. I'd like to ask you the question I ask all my guests at the beginning here. What is your current assessment of the global economy and financial markets?
I would say let's start with the U.S. and then we'll kind of broaden it out a little bit. The U.S. the inflation is definitely baked in the cake because the excess money that's been created in the past by the Fed is still hanging around and still has to leak out into the economy. So I think by the end of this year, if you run even the simplest kind of numbers, you're going to still end up with inflation at 7%, and 2023 might be down just a little, but let's say 6%. So it's drifting all the way into 2024. And if you look at the break-even rates that are baked into the market right now, the 2-year break-even rate is only about 3.6%. So the markets, I don't think, have this thing right. I mean, basically, since this whole thing started, the work John Greenwood and I did, we've been right on target, right in the bullseye, and the markets have just been off. They've never digested the fact that we have a great inflation right now, and they still haven't digested it. So they're going on, and they've bought into all these ad hoc theories for why we have inflation. It was COVID, then the whole thing was just a temporary supply chain glitch that was going to be over very soon, and then the oil market, and then Putin, is the latest thing, and all these things are really ad hoc explanations for why we are witnessing so much inflation. There is only one cause underlying it all, and that's an excess amount of money that's been created, and that is a result of step one. The government started spending a lot of money when COVID hit in early 2020. I mean, Trump was the president then, but there was a lot of spending, and then Biden comes in, and the spending really goes on steroids. And as a result of all this spending, the government deficit goes way up. And who purchases the bonds that are financing the deficit? The Federal Reserve. And when they do that, they crank up the printing press. And so we've had this huge increase in the money supply since February of 2020. The cumulative increase in the money supply is about 40%, almost 41%. So of that 41%, we use some of it to accommodate real economic activity, real growth, real GDP growth, and some of it also to accommodate increased demand for money. And we're still left with about a 30% cumulative increase that's excess, that's will eventually come into the system as inflation. So that's why I say we've got this inflation thing with us. So inflation is with us in the US. We also have a very high probability of a recession, I think maybe 70%. Now, if you go to Europe, the situation's even worse than the United States. And if you go to the UK, it's even worse. So those are two, we're talking about two big economies in addition to the United States that are facing the stagflation kind of scenario. We also have China, very big economy, and they have locked down and have this zero COVID policy that, if you lock everybody down, keep them home, what happens? Well, the economy slows down. Now, their inflation, by the way, is in pretty good shape in China. It's running now at about 2.5%. 2.1%, which gets back to this money supply thing, Adam. They have controlled their money supply. So the idea that inflation is some global thing, this is a lot of nonsense. It's always local. It's produced by local central banks. Whatever the local central bank is doing will affect the quantity of money, and the quantity of money is what drives ultimately inflation. If you look at Japan, for example, they have an inflation rate of 2.5%. The money supply has not been growing as rapidly as it has in the United States or in Europe or the United Kingdom. If you look at Switzerland, they have an inflation rate of 2.9%. And again, the Swiss National Bank has been keeping the money supply under control, and they have relatively low inflation at 2.9%. So there are just so many things out there that people are reading in the press, Adam, and the financial reports from investment banks every single day. It's just all wrong. Inflation is not a global, it is a local. Point number one. Inflation is not caused by all these ad hoc reasons that we see in the newspaper all the time. So they're still going on about supply chains and the Putin effect on the oil market and so forth. It's all tangled up with the money supply. And in this regard, for your viewers, I think my 95% rule is what they should keep in mind. And that is 95% of whatever they're reading in the financial press is either wrong or irrelevant. 95%. And it's probably great. It's probably greater now. Anyway.
All right.
That's kind of an overall, somewhat, shall we say, disturbing picture, because we do have a lot of inflation in many places, not Japan, not China, not Switzerland, and a few other places, but there's a lot of inflation out there that's been created by these local central banks. And we have the prospect of recessions hitting. And the recessions hitting are a combination of what? These central banks getting afraid of inflation and starting to tighten up. And most of them, since they don't know where inflation even came from, most of the central bankers, they never predicted it. I have some doubts that they know how to tame it, and they might overdo it. And if they overdo it, of course, that'll send the economies into recessions. That's one problem. The other big problem are these sanctions that are being placed on Russia. This is a big problem. We've weaponized the financial system, kicked Russia out of the the dollar-based Swift payment system, for example, and put a variety of sanctions on Russia that have very much disrupted the oil market completely, and that those disruptions do cause problems, and that's where the real economy gets hit. It isn't the inflation that gets hit; it's the real economy that gets hit with all these disruptive factors that are the result of negative unintended consequences stemming from these sanctions, which every week we have a whole raft of new sanctions being put on Russia. And these affect things, in particular, the relative prices of food and energy are being affected by this.
All right. Well, look, Steve, you great answer. You touched on a whole number of things that I want to talk about with you here. So bear with me as we just sort of dive into them all together. But first, it sounds like you've just given Milton Friedman a wonderful victory lap here with his quote, inflation is where is it? Everywhere and always a monetary phenomenon.
Always and everywhere. That's Milton. Yeah, this is Milton Friedman 101, no question about it. What's called the quantity theory of money. The quantity theory of money is encapsulated in an identity, a famous identity called the equation of exchange. MV, money, times velocity is equal to PY. P is the price level and Y is real economic activity. So if we look at that equation of exchange, that identity, it's an identity and it must be true. So, and if you know how to use it, of course, it's very helpful. And that's what John Greenwood and I did when we predicted that now we would have inflation. Early last year, we predicted that now we would have inflation of 6%. And we said maybe as high as 9% in the United States. Well, what do we have? We have 8.6. So it's pretty good.
It's pretty darn close.
So,
Rounds up
so
to 9.
whether you like this equation of exchange or not, or you like Milton Friedman or not, we used it and we were right. And the thing that's fascinating to me is there's very little reportage on this. If you look at the press, okay, Greenwood and I write articles in the Wall Street Journal and a National Review, and yeah, you see it there. But have the reporters picked up on it? No, they've canceled this. In other words, you have two economists who have a model, an identity, MV equals PY. We used it. It's been around since the 16th century and is very reliable if used properly. And we got the right number. You would think that would be all over the press. Well, you have to comb through the press very carefully to find any reporting about what Greenwood and I actually did.
Right, which I think underscores your other important equation there with the 95% rule, right? It's just that.
Well, the 95% rule is golden, and the equation of exchange, the old quantity theory of money, is golden too. Now, if you look at the quantity theory and the equation of exchange, Adam, it's this identity, and use it properly. If you solve for M, and solving for M, what you want to do, that's what I call the golden growth rate. We're solving for M and plugging in some numbers here that would give us the rate of growth in the money supply that's consistent with the Fed hitting its inflation target of 2%. So let's do that. So we have M is still on the left-hand side of the identity, and we pull the V around to the right-hand side. So V becomes a negative number. It's negative. So we have M equals P, change in P, change in Y, and minus the change in velocity. Now, velocity happens to be trending at a very constant rate of close to -2% per year. So we've got a minus and a minus, that's a plus. So we have what? 2% is a P, that's an inflation target. 2% is roughly the GDP potential in the US. And then we've got the last thing we're adding is 2%, which is the velocity number. So 2 plus 2 plus 2 is what? 6.
6.
6 is about the golden growth rate. 5 to 6. And it has been growing what? Almost 18% in the United States, 3 times faster than the rate that would be consistent with hitting an inflation target of 2%. And that is why we have so much inflation in the United States. That's why when I say excess growth in the money supply has been growing much more rapidly than the golden growth rate consistent with hitting an inflation target of 2%. And you get all of that out of this little identity that I just attempted to walk you through, MV equals PY.
All right, no, that's great. You're giving us a nice.
And if you look, of course, Milton Friedman has the classic entry in the Palgrave Dictionary, which is the most famous dictionary in economics. It's on the quantity theory. And of course, if you read Milton Friedman on the quantity theory, in the entry in the Palgrave Dictionary, you will find MV equals PY, and he explains how to use it and what it's all about.
All right. Well, I love the fact that you're walking us through, sort of a graduate level progression here, but showing how it actually has real world, implications that we're living through right now. So where I want to go with this is, you've got this concept called the monetary bathtub, which is sort of what you're talking about here. And right before I ask you to explain it further, you're talking about here, we had a huge excess in the currency supply, and we're getting inflation. And Friedman would have said, hey, no surprise there, right? So the pandemic hits. Within the next year and a half, the Federal Reserve increases its balance sheet by over $4 trillion. Congress issues over $5 trillion in fiscal stimulus. How did the Fed get this so wrong? How did they not think that this was going to unleash the inflation it has?
The Fed got it wrong because they've canceled the quantity theory of money. They've canceled Milton Friedman, in short.
And why?
That's well, this is interesting. Modern post-Keynesian economics is that is the kind of economics that is taught in almost all graduate programs around the world, literally for the last 30 years. So the trend and dominance in the teaching of macroeconomics has changed a lot and basically destroyed the equation of exchange and quantity theory of money kind of idea. In other words, for me and for somebody like John Greenwood, my associate, MV equals PY is the theory of everything in macroeconomics. But that's been kind of intellectually, shall we say, canceled and moved aside. So that's one factor. The other factor and reason that the Fed hasn't been looking at the quantity theory is the composition of staff members at the Federal Reserve. You've got over 450 economists at the Fed in Washington. In the whole system, you have over 700. I think 785 economists. Now, none of them got it right. That's your question. I mean, these are the technicians, the technocrats. Why? And if you look at the composition from a political point of view, at headquarters, the Democrats on the staff outnumber the Republicans 48.5 to 1. 48.5 to 1. So they're essentially all Democrats. Now, if you're a Democrat, who's the economist that really has to be canceled and taken out of the picture? It's Milton Friedman. And enemy number one of the Democratic Party machine is Milton Friedman. In fact, in 2020, President Biden actually said, and this is a quote, Milton Friedman isn't running the show anymore.
Interesting. And for folks that aren't as steeped in economics as you are, can you just explain why apparently his policies are sort of anathema to them?
I think they're, well, number one, he's a free market economist, so and an anti-statist.
Okay.
Milton Friedman thinks the optimum, thought, unfortunately, he's passed away, he isn't with us anymore, except in podcasts and so forth. And he's very effective and alive and kicking in podcasts, which drive the Democrats nuts, because he's a very clear pedagogue. He's a good teacher. He's a great economist, of course, Nobel laureate, and very much a free market, small government type. He thinks the optimum size of the government should be about 10 to 15% of GDP. Well, we're like 3 times larger than that.
Right. So anybody who's big government obviously isn't a fan of him.
Right. So it's big governments versus small government, discipline and control of the money supply, balanced budgets, all of these things that obviously don't sit very well with Democrats. They want a bigger government. They have embraced modern monetary theory, which essentially says that you can spend as much as you want and let the central bank finance it, and it's not going to cause inflation. Well, we've seen how well that experiment worked in the last couple of years in the United States. So that's, you have 2 things going on. One is that the economic models are not consistent with the equation of exchange. They're a different kind of model. They don't include money. The modern post-Keynesian macroeconomic models do not include money. Well, the equation of exchange and quantity theory of money is focused on money, is the big elephant in the room. So that's, the theory is different. And then you look at the makeup of the staff and their political inclinations, and I think that is significant because they don't like all the things that Milton Friedman stands for, basically. So, and one big thing he stands for happens to be the quantity theory of money. So if you don't like Friedman, you're canceling Friedman. You're canceling a lot of ideas that just don't go down very well with the Democrats. And one of those happens to be the quantity theory of money.
Got it. So it sounds like what you're saying is a big reason the Fed sort of missed the implications of all the money printing is an ideological blindness, right? Sort of the analogy I'm thinking in my mind as I hear you talk, it's like pilots getting into a plane and saying, you know what, we're just agreeing the altimeter we don't care about, right? Just like they're ignoring the quantity of money, the pilots are ignoring something that's critical to actually flying an airplane successfully. And of course, if you do that, it's not likely going to end well for you.
Absolutely. I mean, if you're a central bank and you don't have money on the altimeter, you're flying blind.
Right.
And if you don't have that altimeter with money on it, you're also, if you're trying to control inflation, you're kind of grasping for straws. You don't know exactly what to do. So that's why I say there's a high probability they'll make a mistake when they try to control inflation. they didn't get it right. They didn't anticipate it. They had no idea what was going on. And now they're hitting the panic button and indicating that they want to get inflation under control. And I think they're grasping for straws because they don't have the right theory. They don't have the right model of the whole thing. They don't have the quantity theory of money. And in fact, Chairman Powell last year, actually in congressional testimony, said we had to unlearn this. We had to unlearn the quantity theory of money and the fact that there's a relationship between the growth in the money supply and nominal growth in GDP. And the nominal growth in GDP, of course, contains a real component. That's just why the kind of potential of 2 or a little over 2%. And the rest of whatever happens to be going on with nominal GDP is inflation. So you've got inflation plus the real component equals nominal GDP. And the equation of exchange is just a model for determining where nominal GDP is going.
All right. Okay. So I'm going to pound through a couple things here, Steve, just to get to some key questions coming out of this. But so, it sounds like you're saying, hey, look, it's not a new criticism of the Fed that they sort of lurch from policy mistake to policy mistake. Sounds like this ideological blindness that they had to Friedman's work and the equation of exchange has definitely exacerbated things here in the here and now. It's funny, even Michael Burry just came out with a tweet the other day, basically citing the bullwhip effect, saying he expects sort of the same thing, which is the Fed is going to lurch from one extreme policy to the next, trying to sort of chase the shockwaves of inflation and its policy attempts to control it, and it's going to be kind of just following along, making the situation worse every time it lurches in a different direction here. So I want to talk about the monetary bathtub for a second, and I want to get to the key question of, okay, so where do you think things are going to go from here? And you already gave us a little preview that it sounds like you think inflation is going to stay pretty high for a fair while here. But this monetary bathtub concept you have, I've sort of been referring to it in previous videos as the pig through the python, where we pushed all this new money into the system, and it takes a certain amount of time to work its way through. And a key question that I honestly haven't really had a ton of visibility into is how much of the pig is left in the python. And it sounds like you're saying there's still a fair amount. Again, you use the monetary bathtub analogy. I'd love for you to explain that a little bit further, but it sounds like there's still a lot of excess that's sloshing around that bathtub.
Yes, the monetary bathtub is as follows. You kind of visualize, you've got the faucet, and through the faucet, the money is coming into the tub. And then you've got two fundamental drains. One drain is the drain taking money out of the bathtub to facilitate real economic growth. And the other drain is one that accommodates the increased demand for money as the economy is growing. So, and then if there's something left in the bathtub, that is what goes out the overflow valve or the inflation valve. And what we've had since February 2020, going into the faucet, we've had about a 41% cumulative increase in the money supply since February of 2020. So that's gone into the tub, and those two fundamental drains for real economic activity and the demand for money, that's drained about 10 or a little bit more than 10 percentage points of those 40 percentage points out. So you're left with an excess in there of about 30% cumulative. And that comes out with a lag of long and variable lags, comes out as inflation. The lags are usually between 12 and 24 months. That's why I'm saying the thing's kind of baked in the cake, Adam, the inflation. You can't just turn it off immediately. Even if the Fed reduces the growth rate in the money supply measured by M sub 2, and they reduce that down to a golden growth rate of 5%, you're still going to get this excess coming out. And it'll take a couple of years for that to fully drain out of the tub.
All right, so this is really important. I think this is a missing puzzle that other speakers I've talked to haven't had that you're providing here, which is there's more inflation baked in the cake here. There's more of this excess sloshing around in the bathtub than maybe most folks realize, or there's more pig left in the python, to use my analogy. So much so that you think it's going to keep the CPI high. And if I took good notes at the beginning, I think you think it's going to average around 7% this year and maybe around 6% in 2023. Is that accurate?
Yeah. At the end of this year, I don't see how inflation on a year-over-year basis can be less than 7%. And at the end of 2023, the same exercise is probably going to have you around 6%.
Okay, so just to correct, I was wrong. They weren't averages; they were the end of year numbers.
Yeah, end of year, year over year. So the end of 2022, December 2022 versus December 2021, the percentage change can't be really lower than 7%.
Okay, so let me ask a couple of important questions from here then. So first off, it sounds like what you're saying is we will be seeing disinflation going forward, but like extremely mild disinflation, where CPI is still very high.
Right, and the reason for that is this big excess that's in the tub. Yeah.
Right, it's got to come out that drain. It can't come all out at once. Right. It just takes its time.
It's going to go out the overflow valve, and it takes time. And as I say, these lags are long and variable, but they're usually run about 12 to 24 months.
Okay, so I want to marry this now. Sorry, you had one more question or one more point?
No.
Oh, okay, so I want to marry this now to your concerns about recession, where you pegged about a 70% recession risk, which is high. And a lot of the folks that I talk to on this channel agree with you that they're also very concerned about this. So if we enter a world here where economic growth continues slowing, and it looks like GDP for Q2 is going to be 0% or negative, right? So we'll have net contracted for the year GDP wise so far. This high inflation, it hurts consumers, it reduces consumer spending, which is 70% of GDP. It hurts corporations, it compresses margins. So, you know, we could easily go into a recession here. It sounds like you would sort of categorize this as sort of like classic stagflation, where prices remain really high, but economic growth, you know, stagnates. Is this going to be an entirely stagnationary recession if we go into one, or do you see it at some point tipping more into stronger disinflation, even maybe more deflation once the bathtub is more empty?
I don't really have a profile or even a duration on or severity for the recession. All I'm convinced of, and I think the main thing that people have to be concerned about always if they're trading, for example, is what's the direction of things.
Yeah.
And I think they're going down. How far down? I don't have any particular insights about that, or the severity of things. I don't have any particular insight about that either. The one thing that I'm pretty convinced of, as you say, a 70% probability of a recession puts me up on the high end of the distribution. In other words, some people think there's a 0 chance, and the ones that think that there's a pretty good chance the high end of the distribution would be up around 70%. For example, Larry Summers, a former Secretary of Treasury, economist at professor at Harvard, Summers thinks that probability is about 65%. So,
okay. And he's a smart
so
guy, and one of the guys like you who warned about the inflationary repercussions of what the Fed was doing last year, right?
Yeah, yes. Summers did warn about that, and for different reasons than I did. See, Summers' analysis, he got the direction of things right. We are going to have more inflation. He didn't put a precise number on it as Greenwood and I did, but his theory, he's a fiscalist, not a monetarist like myself, and his reasoning was that we were spending a lot of money and the deficit was increasing, and that was going to overheat the economy and we would have inflation. That's in simple terms, that's his analytics.
Okay. Which I guess he could have declared victory on in Q4 of last year when we got up to 6 point whatever inflation and we had 6% GDP.
well, he, so as far as it goes, that's fine. But what Greenwood and I, or Milton Friedman, or monetarists do, we look at that deficit, and the deficit, it depends on how it's financed, whether you get inflation or not. And if the Fed monetizes that deficit, which they did, they purchased most of the Treasury bills and bonds that were issued to finance it. They create money to buy those bonds. And that's why you say, well, the Fed's balance sheet increased. You were talking about that earlier. It increased. Why? Because they were buying bonds. And
it was funding what became the fiscal stimulus. Yeah, it was the enabler.
Oh, right. So you have to have the Fed and the central bank in the picture to have inflation in the picture, and go back to the equation of exchange, MV equals PY. So, and let's put it this way: if the government spending would have increased, if the deficit increased, and if those bonds would have been sold instead of the Fed to the non-bank public, we wouldn't have had inflation. Because what happens? They sell the bonds to Adam and Steve and this person, that person, and that takes money out of your pocket.
Right, exactly. The money supply would stay the same. Exactly.
You have to pay for the bond. So you give them money and you get a bond in exchange. And in that scenario, that is not an inflationary scenario, because no money has been created. There hasn't been any new money that's created. The only thing that's happened is some of your disposable income, some of my disposable income is being sent to the government to buy the bonds, and we get a bond from the government. So we have no inflationary effect. If that's the means of financing the government spending and government deficit, what we had instead was the bonds were being sold to the Fed, and the Fed, they didn't reduce their disposable income to buy the bonds. They created money out of thin air and credited the government account for the purchase of the bonds that were eventually expanding their balance sheet like mad. And it's that increase in the money supply that causes inflation. Gets back to your quote about Friedman.
Right.
Inflation is always and everywhere a monetary phenomenon. That's how we're wrapping this story together, this conversation we're having.
All right, great connecting of the dots there. So here's the key question I want to get to, which is the Fed has created this hot inflation, which is creating lots of issues, both for households and for corporations. It's got the administration in a total panic because it's a stone cold election killer, as every politician knows. So a lot of the people and we think we're going to head into a recession here, right? Which is also compounding the problem. The Fed's rate hike campaign that it's on right now and its initiation of quantitative tightening is certainly not going to help on the recession side of things. It's going to contribute to it. So a lot of what the people I talk to, the experts I talk to say is hey, the Fed is going to hike rates until it breaks something. And when it does, many of them think the Fed is going to then be forced to having to pivot back to easing. And I want to, get your sense of what you think the odds of a Fed pivot are, but also ask the question is, can the Fed really pivot if inflation is going to remain as persistently high as you think it will? Does that really hamstring the Fed from being able to go back to easing? Because if it does, it's just going to reignite the inflation problem even more.
Well, first, let's take it. If they start raising rates and then...
Our interview with Steve will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And last, if the challenging macro outlook that Steve has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Steve has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Steve Hanke.